All right. So in the risk assessment process, this is basically if you're talking about a big organization, so they would have the risk committee, which consists of, it would be chaired by by a non-executive director, okay? And then they would be looking at all the risk associated with that organization. So let's say a company is planning to invest in a new country, right? So that risk committee or risk assessment department, they would be looking at the risk associated with that decisions. Okay, so that's that's one risk. Probably you could have the regulatory risk. Regulatory risk would be that you are not you are if you are not following the regulations, that would be known as regulatory risks. Okay. Uh, that can be a financial risk if the company is about to run out of cash. So that would be financial risk. So in risk assessment process, you identify the risk, then you analyze the risks. Okay. Analyze means you assess the likelihood and impact of each risk. You assess the likelihood and impact of each risk. Likelihood is the probability, what are the chances that it will happen. Okay. And impact, what's going to be the impact on the organization. Okay. So, sometimes we use a matrix for this assessment. So likelihood can be high, medium, or low. And impact can be high, medium, and low as well. Okay. And so what you're going to do is you are going to, let's say you have a couple of risks in front of you, and the risk committee or the risk department, they are going to analyze the risk, and they are going to see what is the probability of that risk happening. Okay. So if the probability, so on the basis whether the probability is high or low, you um, you uh, you put the risk in the matrix, and in the same way, we look at the impact. So what's going to be the impact on the organization of that risk, whether it's going to be high, medium, or low. And on the basis of that, you would be assigning the numbers to the risks. Okay. We are going to talk about that. We are going to do an illustration to understand it. So, okay, we're going to do that later. Then we prioritize risks. Okay, so let's say um, on the basis of the matrix that we just made, on the basis of likelihood and impact, we are going to prioritize our risks, um, and see that which risk gets the first priority. So which risk is going to get the second priority, and etc. And on the basis of that, you start resolving the risks. Okay, and then you develop the responses. Okay, okay. Let's talk about the example. Okay, let me share an example with you. All right. So here we are taking on y-axis, we are taking likelihood. On an x-axis, we are taking the impact. So likelihood can be high, medium, and low. In the same way, impact can be high, medium, or low. So we decide that we are going to assign 3 score to the high likelihood, score 2 to medium likelihood, score 1 to low likelihood. Same is the case with impact as well. Yeah. All right. So for example, um, the storeroom where the company is keeping the um, inventory, that storeroom is not locked, okay? And all employees have the access to the storeroom. And so the likelihood of um, that someone's going to enter the storeroom and steal the inventory is very high, right? So the likelihood is going to be high. The so we know that the score we would be assigning to that risk would be 3. But impact, if someone's gonna steal some inventory and you think that they are not going to, like, they cannot steal like all of it or a big portion of it. What they can do is they can just steal like a couple of units. So the impact of that on an organization is going to be low, right? So impact is going to be low and likelihood is high. So you multiply 3 with 1. So score you would be giving to that risk is, you will be placing that risk in this box. Score is going to be 3. Okay. So we can say the store lock. All right. Um, Another example is like the credit card, which is used to purchase the inventory. Um, Everyone in the purchasing department has access to that, and everyone can go and do the purchases using that credit card. Okay. So likelihood is high, and if someone does that, so when they're going to do some purchases from credit card, that's going to be a little higher, right? That's going to be on the higher side. So impact of that on organization would be medium. Okay, likelihood is high and impact is medium. So you would be placing, let's say, I call it CD, credit card risk, CDR. Okay. So I'll be placing it in this box, and the score I would be assigning is 6. 3 times 2, 6. Okay. If I'm placing something in this box where the likelihood is medium and impact is high, so that's going to be 6 as well. And something which we would be putting in this box, so likelihood is high and impact is high as well, so that score would be 9. Okay. If something is coming in this box, so likelihood is low, impact is low as well, so the score is 1 only, right? So you could see that you have assigned scores to different you have assigned scores to different risks, right? So this is called the prioritizing. Okay. Now you know that which risk has first priority. So this is the one which has first priority, right? because it has score of 9. Then these two risks comes, they have second priority. And then you have this one with third priority, and this is the fourth priority. That's how you decide the priorities for different risks. Okay. In risk assessment process, the first thing is identifying the risk. The second is analyze the risk. So identify is like, you realize, okay, everyone is using the credit card. That's a risk. So this is what that's the point when you just realized that this is the risk. The second point can be, the second step can be when you analyze it. Okay, you analyze the risk on the basis of likelihood and impact, and you assign scores to different risks. Then you prioritize them, and then you drive responses. This is your risk um, assessment process. That's the second component of your internal control um, of an organization. The first one was control environment, in which you develop a culture and values and norms where everyone is taking care um, of the internal control systems. The second component is the risk assessment process. Okay. Then we have information system. Information system for any organization is basically the system which provides information throughout the organization. Now, you must have heard about the softwares like SAP and Oracle, right? And so these are the ERP systems. So they are responsible for transferring information from one part of the organization to the other. So a strong, good information system is also part of the internal control system. Okay. Then we have control activities. We have already talked about it. Supervision, segregation of duties, physical controls, authorization and approval, arithmetical and accounting controls, personnel controls, right? So we have talked about the control activities already. Then monitoring of controls. So once you have developed that control system, now you have to keep on monitoring your control system to see whether the control system is working efficiently or not. Okay, so ongoing monitoring, separate evaluation, reporting deficiencies. So what you do is you have a control environment, you installed the control environment. Now you have to monitor whether your control environment is effective or not. Um, let's say you have the information system, which is providing information throughout the organization. The information system is responsible for letting you know if there is any anomaly or if there is any uh, suspicious transaction, right? So for that, you would be providing the uh, your information system would be providing the alarms, right? Then you just have to keep on monitoring whether the system is working or not. Okay, so this is monitoring of controls, which we need to keep doing it. Okay, so components of internal control system is control environment, risk assessment process, information system, control activities, and monitoring of those controls. Okay, you keep on checking your whole control system every now and then to ensure that your control system is working effectively, right? Okay. And then, obviously, internal control system has got its own limitations as well, like human error, collusion. Sometimes, you think that you have segregated the duties of two employees and you made two employees responsible for something, right? And now they have got that they collude with each other. Collude mean they have a tacit understanding and they are working together to commit a fraud or something, right? So obviously internal control system cannot work over there. You install a segregation of duty over there, but that's not working anymore. Let's say you installed supervision, so junior was supervised by the senior, but both of them are working together to collude, right? And they are committing the fraud, working together. All right, this is collusion. That also, and that's one of the limitations of the internal control system. The management override. Management override is sometimes management. Let's say there is an internal control system, but management says that, like your CEO or your marketing head or some HR head, they say that, okay, don't care about the internal control for now. I want this task to be done by any means, right? So management overriding the internal control system. That's another limitation of internal control. Then we have to think about the cost and versus benefit. Um, what is the cost you are incurring on your internal control system, and what are the benefits you're getting from that? Okay. All right. Then we have okay. So these are the limitations of internal control system. Now we are going to talk about the internal audit. Internal audit is basically the department. Internal audit is part of the internal control system because the difference between internal audit and external audit is that external audit works for the external stakeholders. Like external auditors are ensuring that the financial statements. Thank you. The financial statement which shareholders are going to use are representing true and fair view, right? So this is for internal audit. That's the responsibility of the internal audit department, right? External audit department, because they are working for the shareholders. But on the other hand, internal audit makes sure that the organization is working effectively. Internal auditor will keep on checking the control systems and see that whether the effectiveness of the internal control system is there, right? And they would check everything. They do the fraud investigations. They do the compliance reviews to see that whether the organization is complying with all the regulations. And then value for money audits is like they would they would be auditing an activity and see that whether the activity is bringing the value on how much we are spending on that. Okay, so that's internal audit. We have internal control questionnaires. So that's another part of internal control questionnaires is more like the SOPs. So they are used by the auditors and managers to assess the effectiveness of internal control. So you have a list, you give it to different people in the organization, and they just have to fill these forms, and on the basis of the results, they would check whether the internal control systems are being followed or not. Yeah. All right. Okay. Now we are going to talk about the different control systems. Okay. Like, what are the control systems in sales? Obviously, the first thing we need to understand is that what is the sales function, right? So what is the process of sales? So, you know, you and what do you want? What are the objectives of the sales control system? You would like your goods to be delivered only to the credit-worthy customers, right? Because you're making the sales, you're giving them the credit, and they're going to give you the payment after a certain period, right? And there is a possibility that they are now going to make the payment. Okay, so say so objective is that the goods are only supplied to the credit-worthy customers. Orders are dispatched accurately, completely, and in a timely manner, and only valid sales transactions are recorded in the accounting systems, and all sales are related, receivables are recorded accurately. Okay, so you are recording the receivables, so you don't want to record any fictitious receivables or anything, right? And revenue is recognized in accordance with applicable accounting standards. Okay, so these are the prime objectives of control system. So what control systems we can use for this? We can use credit control. Credit control is the process in which you assess the credit worthiness of the customer, and you see that whether this customer is worthy enough to give them the credit or not. Okay, and you would only be giving credit to the customers who pass your test, because you don't want that risk. Okay. Order processing. So ensuring that customers' orders are authorized, recorded, and fulfilled accurately. Okay. You don't want to make any mistake in that. Invoicing. So you generate and send invoices promptly and accurately to customers. Then revenue recognition. So ensuring that revenue is recorded in the appropriate period, reflecting when goods and services are delivered. Then we have purchase system controls. Okay, so what is purchase system? Purchase system is you order your goods, right? You receive the goods, then you receive the invoice. Um, you record the transaction, make the payment, and then those goods go to the store where it is recorded in the inventory. That's your purchase system. So what what is the possibility that what can go wrong in your purchase system? So uh, you only want your purchases from reliable suppliers, okay, uh, who are of appropriate quality and price. Okay? Only valid goods and services are procured, because you don't want you don't want to receive goods which are substandard or are not timely, because that's going to cause you problems of the efficiency and effectiveness, because if you're using wrong materials in your production process, you are going to get delays in your production. You are going to get the complaints from your customers. You would be wasting some of the amount um, in uh, in the wastage as well. So that's going to be more costly. Okay. All purchases and related liabilities are recorded accurately, right? And expenditure is controlled and aligned with budgetary constraint. So the purchase department was given a budget at the start of the period, in which they were given the budget of the price and the total quantity, that how much they're going to purchase in the whole period and at what price they can purchase. So that so you want to make sure the budget is being followed. Okay. How can we um, make the control system here? We can provide supervisory controls like segregation of duties. So we ensure that the different individuals handles various stages. Like the person who is placing the order is different from the person who is receiving the goods, uh, and and that is different from the person who is approving the payments, right? If the same person is making the orders and you know has the authority for the approval of payments as well, there is a possibility that, you're going to have some fictitious purchases. You're going to make the purchases, he would never receive those purchases, and he would collude with the supplier, and he would get the amount, okay, and he would never receive the goods, okay. So segregation of duties is very important here. And approval processes, like the if a certain member of staff is given a certain limit, they can purchase till that amount. If they have to make purchases beyond that, they'd have to seek approval from any of the other um, person in authority, right? The approval process is also used as a supervisory control. And then supplier vetting. So evaluating suppliers for reliability, quality, and price competitiveness. All right. So this is what you do in purchase system. Okay. So in the exams, you're going to get the scenarios. Probably, you would be given a sales control system, and you have to identify the weakness, evaluate the impact of that weakness on the organization, and then you have to give them the remedy for that. How can we get rid of that weakness? So you can keep the this information as reference. We talked about sales system, purchasing system, then we have payroll systems. So payroll system is that a payroll, you make the payrolls, right? So one person is responsible um, for making that log, and filling all of those cards and making the payroll. Okay, and then the there would be, if there is any deductions or additions. Deductions could be um, uh, because of the late coming, or because of the uh, offs the employees taken, or addition could be because of the extra hours any employee worked, right? So you get one person responsible for making the payroll, then you do the additions or subtractions, then it would be given to a supervisor who would authorize it. Then payments would be made to the employees and the tax authorities, uh, because one portion of the amount is also made to the tax authorities if tax is applicable. Pay system, pay as you earn. And lastly, then you record the transactions. What can go wrong in payroll systems? So only genuine employees are paid. So there is a possibility that some fictitious employees are added in the payroll, and someone is getting paid even though uh, they are not actually real employees. So some of your member has added a fictitious employee, and they are getting the salary of that employee every month, right? So you want to make sure that only genuine employees are paid and they are compensated accurately for the work performed. We have payroll calculations, including deductions for taxes, pensions, and other contributions are accurate and compliant with regulations. You don't want any wrong calculations, and payments are made on time, and records are maintained for statutory and internal reporting purposes. Okay. So these are the objectives of the payroll control system. What can you do to ensure that your payroll system uh, uh, has good internal controls? Employee records, so maintaining accurate, up-to-date records for all employees, including personal information, employment terms, and pay taxes. So you can make sure that there is no fictitious employee or you're not paying someone extra or something. Then you have timesheets and attendance. So your timesheets and attendance are records are straight, and there are no errors in those records, right? And you make sure that when you're making the payroll, there is no error while you are reconciling with your timesheet and attendance. Then we have payroll processing, right? The payroll processing, you ensure that the payroll calculation are accurate and that payroll reports are reviewed and approved before payment. Okay. Then we have tax and compliance, so ensuring that all statutory deductions are made accurately and paid to the relevant authorities. Okay. So this is what you want to make sure for the payroll system. Then we have inventory system controls. So inventory system involves two types of inventory. One is for the purchases, the second one is for the sales. So if you're purchasing, so you're ordering, you are receiving the inventory, you're making the payment. So inventory goes to the store and where it is recorded. In the sales, the inventory of the finished good is going out of the store. Yeah. And you receive the payment, record the transaction. So you want to make sure that there is no theft, there is no and the inventory figures are not inflated or deflated, right? They are accurate numbers and inventory is not damaged or something, right? So you want to make sure that. Let's see what are the objectives of inventory control systems. So inventory levels are maintained to meet production needs and customer demand without holding excessive stock. You don't want to hold excessive stock. Okay. Inventory is safeguarded from theft, loss, or damage. Okay. What can be the key controls? Physical security, like you're locking the store. Inventory counts. Inventory count is a process in which after a regular period, like every week or after 15 days or a month, um, people go to the inventory store and they count the inventory and see that if there is any theft or damage or right. So this is called inventory counts. So they just want to make sure that the inventory which is being showed on the system aligns with the physical inventory which is here. Okay. Let's say my information system is saying that I have 15 kg of a certain material. So I would go and weigh that material and see whether actually, it is 15 kg or is it more or less. That's inventory counts. Then we have inventory valuation. So applying consistent methods for valuing inventory, like FIFO, LIFO. So you are valuing the inventory properly. I mean, using the standards. Okay, then we have cash systems. So cash systems controls, um, you know, you are receiving the cash from customers, you're making the payments to your suppliers, and you're making the payment for the expenses as well. Um, so the cash system, whenever you hear the word of cash, um, the cash is the easiest thing um, to do fraud. Yeah. So it can easily be misappropriated. So the control system for the cash should be very strong. So control over cash handling and cash transactions are crucial to prevent theft, fraud, and mismanagement. So objectives are maintaining minimal cash levels to reduce the risk of theft or loss. You want to keep cash as minimum as possible. You want to do major of your transactions through bank so that um, you don't keep a lot of cash with yourself. Ensuring that all cash transactions are authorized and recorded accurately, safeguarding cash through secure handling and storage procedures. Okay. Key controls, cash receipts. So whenever um, you are doing some cash collection or if you are making any expense. So there should be cash receipt with that. Cash disbursements like requiring authorization for all cash payments, right? Maintaining proper documentation. Like if you are keeping 10,000 worth of cash in your till, in your cash till for the expenses, so you can say that, okay, any expense which is more than 500 should be authorized by the accounts manager, right? So this is the type of authorization you can create to do all the cash disbursement. Bank reconciliation. So you're maintaining the cash book with the company, and banker is maintaining your account with in their books. Okay. You receive the bank statement. You want to make sure that your balance tallies with the balance of the banker, but there is some information which banker doesn't know, like unpresented checks or uncredited checks. There is some sort of information which you don't know, like bank charges which bank deducted but you don't know, and direct debits or direct credits. So after making all of those adjustments, the balance of the cash book should tallies with the balance of the bank statement. If that happens, it means there is no fraud or error. But if there is a difference between the balances, it means there is something wrong, and you need to investigate that. Okay. So you make the bank reconciliation statement after appropriate period. It could be like a week or a month or 15 days. That depends on the type of transactions and the frequency of those transactions. So that would be dependent upon, I mean, if you're handling big transactions every day, and if you're going to reconcile it after a week, so that's going to be risky. So in that case, you can make bank reconciliations every day, right? Uh, so yeah, okay. And then we have check payments. So check payments like the control includes segregation of duties such as separating the preparation, signing, and mailing of the checks. If only one person is responsible for issuing checks, imagine, he's making the checks and he has the authority to sign the check as well. He's definitely going to make some fictitious checks, right? So that will cause the misappropriation of assets, right? Then we have the effect of weaknesses in internal control system. So if there is some weakness, you're going to get a question definitely in which you have to tell the implication of weakness in the internal control system. You can have two type of uh, consequences of the weaknesses in internal control system, like financial misstatements. So if internal control system is weak, there is a possibility that the amount of your assets or amount of um, sales or purchases, anything is misstated. So if something is misstated, that's going to impact your financial statement, your statement of financial position and statement of financial performance, right? So that's going to be the consequence, one, the financial misstatement. Then we have increased risk of theft or fraud, right? So if your internal control system is weak, there is a risk of theft or fraud. Then reputation damage. So weak internal control system can cause inefficiencies, sub-quality products, delays. So inefficiencies, increasing costs. So that's gonna be damaging your reputation as well as an organization. And operational inefficiencies, so weak internal control system would cause delays and inefficiencies as well. And then evaluating weakness, it is essential to assess the potential impact of control weakness and prioritize addressing those with the most significant risks. Okay. All right, so let's try a question. Let me share the question. All right, let me share this question in chat as well. Okay, let's read the question together. So you have been asked to review the procurement and supplier management procedures for a manufacturing company. During your review, you identified several systematic weaknesses that could have significant impacts on the business. These weaknesses include the company does not have a formal supplier evaluation process, does not have a formal supplier evaluation process, resulting in continued partnerships with underperforming suppliers. So it means that you are not screening suppliers before taking them on board. So that would be like very problematic for the company. We'll talk about it. Second thing is the purchase orders are frequently created after the receipt of goods by passing the established approval process. Okay, so purchase orders are only created after you receive the goods. It should have been issued before the goods because first you issue the purchase order and then you you do the purchases. Actually on the basis of purchase orders you order your goods. So what they are doing here is they are just ordering the goods, and once they receive it they just issue a purchase order to fill the file. The procurement manager regularly overrides the approval limits to expedite orders, sometimes without proper documentation. That's an example of override. Okay? And supplier performance matrix are inconsistently recorded, leading to decision making based on incomplete or inaccurate data. All right. Okay. So for each of the four weaknesses identified, first we have to identify and explain the cause of the weakness, cause of the weakness. Okay. And then explain the potential consequence for the business, the impact on business, right? So for each of the four weaknesses, we have to do it, right? We are going to do, okay, just take a minute, like make a map in your mind, and then we'll talk about the answer. All right, so we are running short of time, so quickly, let's talk about it. So the first one. So remember, we have to do two things. One is we have to identify the cause of the weakness, and then we have to talk about the impact of that weakness. Okay, so I'm going to write. So I'm going to write the quick answers, the keywords, which we require. So when company does not have a formal supplier evaluation process, so the absence of formal supplier evaluation process is due to uh, lack of focus on supply management. So it is actually indicating that management does not have much interest in supply management, which can be a problem, right? So yeah. So this is the cause of the problem. Now, if we talk about the company, probably the company is prioritizing the cost saving or speed. Company probably is doing cost saving, or they are more concerned about speed. Yeah, that's good. That's correct. But what we can do is we can, just provide a little more detail, right? Um, because we have to get like 2 marks for just identifying the cause of why it is happening. You'd say that no formal supplier evaluation process is the cause of the management not focusing on the supply management. It can be due to probably the company is focusing on cost saving or speed, or probably they don't have a good control environment, right? So you have to identify the cause, the why it is happening. Okay. Then in second part, you would be looking at the consequences, the why it is happening. So when you don't have a structured evaluation process, the company risks continued engagement with underperforming suppliers. Okay. So you are working with underperforming suppliers, so it's going to lead to inconsistent product quality, production delays, and you're going to have the potential losses as well. So it's going to cause you more cost. Okay? Your cost would be increased because of the inefficiencies and damages and wastages, and you would also risking the reputation of the company because it might result in bad reputation in the market. Okay, so yeah, right. The second thing is purchase orders are frequently created after the receipt of goods bypassing the established approval limit. So the approval limits are not this. Okay, purchase orders are created after the receipt of goods. There is no formal purchase placing an approval system. This can cause receiving completely wrong products or paying wrong value. Okay, all right. Yeah, that's a good starting point, but we have to explain more. So the frequent issuance of purchase order after the receipt of goods, it is due to not having a good procurement or good procurement process, right? So when you what you're doing is you're just ordering your suppliers verbally, right, without the official documentation. So this can be due to, again, the loose or weak control environment in which you are not taking care of the procedures, right? And you are doing it for the speed. Uh, you just want to complete the task quickly. The consequence could be that the companies uh, the company is going to have unauthorized purchases. Okay, so when you have unauthorized purchases, it means that um, someone who is not authorized to make a certain purchase, he's doing it. And when they do it, it might cause the misappropriation of assets, right? It can also be result in error as well. Okay, so and it also makes tracking the taxes, and it will be making it difficult to ensure the accurate financial reporting, right? So it's going to have its impact on the financial statements, and it's also going to have impact on um, the company might be facing some financial losses as well. Okay. All right. So this is the question. If you want, you can complete the question and you can send me the written answer, and we'll talk about it in our next lesson on Monday. All right. And I'll mark the question for you, and that's how you can improve your writing. Okay. All right. Um, I'm going to upload the notes on group. So thank you. Thank you very much. Bye-bye. See ya.